There are currently 10 stocks that I would love to buy at the right price. I'm going to talk about all 10 of those stocks today because some of them you likely haven't heard of, and some of them you definitely have heard of. These companies range in market cap size anywhere from $6 billion to almost $3 trillion. I've sorted them by how close they are to my price target. So the closest one only needs to drop 7% before I would consider buying, but the farthest one would need to drop almost 50% before I consider buying. So I'm going to start with the stocks that are the closest to my price target because those are the ones that I'm watching more closely than the rest. So without further ado, let's just dive right into it, and I'm going to reveal the first stock that I'm watching, which is a smaller company called Darling Ingredients, ticker DAR. Darling Ingredients is an interesting company because they play on the megatrend of sustainability that I'm quite interested in. If you've been around the channel a while, you know that I'm very interested in getting exposure to the sustainability theme, not only because it is good for the earth, but because it makes a lot of financial sense too. Resources on this earth are limited, and if companies can find ways to reuse those resources and repurpose them, I think that makes a lot of sense from an environmental and financial standpoint. So that's exactly what Darling Ingredients does. Darling Ingredients repurposes meat products into new products. So they break down their revenue into 3 segments: feed, food, and fuel. So with feed, essentially they're taking meat byproducts, the unused meat that would normally go to waste, and they're repurposing that into things like animal food. The food segment is things like gelatin, which is made out of animal bones, which typically aren't used for anything. Darling Ingredients is actually one of the largest producers of gelatin in the world. And then this last segment, fuel, is incredibly interesting. Darling turns things like animal fat and used cooking oil into biodiesel that is used for planes. They also claim that they're a leading producer of low-carbon biogas. So this is an interesting little conglomerate that we have here, but their stock is down 38% in the past year, despite the market hitting all-time highs. So what's going on with Darling, and why is their stock down so much? Well, financially, it has not been a good year for Darling. Their revenue is down 17% year over year, and their profits are down a whopping 69% year over year as well. So obviously this year is not looking so good for Darling Ingredients. So why is this a stock that I'm watching? It looks like things are all heading in the wrong direction. Well, Darling stock is cheap. No matter how you look at it, this is a cheaply valued stock. Currently, they have a PE ratio of 15.5 and a price to sales of less than 1. They also have a price to free cash flow in the teens. So all 3 valuation metrics that I tend to look at for companies are significantly lower than my portfolio average. So this then becomes a bit of a turnaround story. We want to see if Darling can return to growth, because if we zoom out, Darling has historically had really nice, steady revenue growth over the past 5 years. So I believe that this may present an opportunity if you're willing to be patient. Also keep in mind that even though Darling's earnings and revenue are down, they are still profitable and they are still free cash flow positive. So just because these metrics are down doesn't mean that they're necessarily bad. They're bad when you compare it to a year ago, but we need to value the company today, right? So has the market oversold this company? Is it now cheap? When we look into Darling Ingredients' investor deck, I see a few glimmers of hope for the company. For one, fat prices have started to rebound. This points to greater demand for their feedstock products. And again, feed was 42% of their overall earnings. They claim that their food segment is down because of lower sales, which makes sense, right? But they're saying that global customer destocking is beginning to slow, so that there may be increased demand for these food products as well. And food was the 3rd segment at 25% of their earnings. Finally, we have that fuel segment where they make fuel for airplanes out of cooking oil and animal fat, which is just mind-blowing to me. And we can see that they are looking to ramp up this aviation fuel unit in the 4th quarter of this year while building out their sales book. Even though if you kind of take a rearview mirror approach, everything at Darling kind of looks pretty bad right now. Revenue and profits dropping quite significantly. However, when we look at the stock today and looking forward, we see a very cheaply valued stock with some potential tailwinds in all 3 of their segments going forward. It also plays on that sustainability megatrend where they are reusing and repurposing materials that would just go to waste, which is not only a good move for the earth, but also financially. So for me, Darling looks like a very interesting stock right now, and I'm willing to start buying shares at $33 a share. That puts the valuation at just under 0.9 times sales. So that's my first stock that I'm watching that needs to drop 7%. Let's look at the next stock that needs to drop 10%, and that is Datadog. Datadog is a stock that I used to own, and it's quite an interesting SaaS company. SaaS simply stands for Software as a Service. While a lot of Datadog's peers, things like Snowflake, MongoDB, Elastic, while those types of stocks have been doing really poorly, Datadog has actually performed quite well, tripling in value over the past 5 years. So what sets Datadog apart? Well, for one, their revenue growth is actually accelerating, not slowing like some of their peers, and they have remained profitable for the past 4 quarters. So that's an entire year of GAAP net profits. So that's great to see. Additionally, Datadog has this rock solid balance sheet where their total cash is greater than the total liabilities, so squeaky clean balance sheet, which I like to see, and they generate a bunch of cash every quarter. The problem is that this is unfortunately an expensive stock, which is why I'd like it to drop at least 10% more before I start dollar cost averaging into the stock. I don't tend to look at PE ratios for growth stocks because growth stocks are more focused on revenue growth, not quite earnings. But we do see that PE ratio is incredibly high, right? 263. But when we look at price to sales, this company has a market cap of $38 billion and annual sales of $2 billion last year. So we are looking at close to 20 times sales. However, as their revenue continues to grow, and if the stock price falls, we're going to see this price to sales ratio come down, which is why I'd like to see a 10% decrease in Datadog's price before I start dollar cost averaging, because I do believe that this is a superior company and deserves a premium valuation. However, just because something is a wonderful company does not mean it's a great investment. Really quickly, before we move on to the next stock, I just kind of quickly want to talk about what Datadog does, because it is also quite an interesting company. Essentially, they are a jack of all trades, so they benefit from this vendor consolidation trend where companies are looking to limit the amount of vendors that they use, so Datadog can help replace pretty much all of these logos that you see in the background for things like machine learning models to IoT to cloud computing applications and more. It's basically a one-stop shop SaaS company where pretty much anything that a company needs to do relating to data or the cloud, you could probably get it done with Datadog. They started out as a monitoring and observability platform, so kind of like Elastic, which I talked about in a recent video, but they have added on so much more to their offerings, including cloud security and cloud service management. So Datadog, very interesting company that should benefit from the trends of big data growth and from vendor consolidation by enterprises. My price target for Datadog is a nice round $100. I try to make my price targets as round as possible. The next stock that I'm watching is Enphase, ticker ENPH, and that one also needs to drop about 10% before I begin to get interested in dollar cost averaging back in. I used to own Enphase and I am still quite bullish on it. However, it's another one of those stocks that might still be a bit expensive even after their downturn. So Enphase is a solar energy and energy storage hardware company. Their primary product is microinverters, which are a small chip that goes on the back of a solar panel. They primarily cater to the residential solar business, which has really taken a downturn lately, but they also develop energy storage devices, aka these giant battery packs. It's a play on solar energy and clean energy and energy storage, all three being megatrends over the next coming decades, I believe. Enphase is a really interesting company because, like I said, they developed these microinverters. So the solar energy that a solar panel generates needs to be inverted before it can be used by utilities or by your home. And traditional inverters will be daisy chained together and then attached to one primary inversion source. So think something like SolarEdge. They do what's known as string inverters, where everything is chained together, then connected to a single inverter. So if something goes wrong with that inverter, all of those panels are not going to work. Enphase uses microinverters, where there's one of these little chips on every single solar panel. So if one of these chips has an issue, it won't affect the rest of your solar panels. So it's just a very smart innovation. Enphase also is an American company, so they benefit a lot more from the IRA, or the Inflation Reduction Act, which is free money from the US government to encourage clean energy production in the US. SolarEdge does not benefit nearly as much as Enphase does, which is why SolarEdge currently has negative gross margins and Enphase has gross margins that are nearing 50%. So Enphase, absolutely a superior company. I think that's just an objective truth. SolarEdge is not as good of a company, but SolarEdge is obviously much cheaper. So there's that debate. Enphase is actually flat over the past year as far as their stock, and their revenue is down 57% year over year. So again, like Darling, everything kind of looks awful at Enphase right now. However, they are still profitable, just barely, and they are still generating those positive free cash flows. So again, like Darling, we need to analyze this company today and look forward and say, is this an opportunity? We can see the faintest glimmer of revenue growth. According to their CEO, this first quarter of 2024 was the bottom. They're starting to see a recovery in the residential solar market. Essentially what happened, in a very brief level, is that interest rates were incredibly low and everybody started financing these solar projects because it was nice to not have to pay your utility company. And as people are buying electric vehicles, they can charge their electric vehicles at home and they can use solar energy to charge their EVs. So essentially you are becoming your own power company and your own fuel gasoline company if you own an EV. So it just made a lot of financial sense, but then rates started to go up, and people were not as happy to finance these electric vehicles and solar panel projects, and Enphase had overstocked with their installers, and they had this excess inventory, and people just immediately stopped buying Enphase products for the time being. So we can believe that this is probably temporary, as solar energy is a mega trend, and I do believe that they will return to growth at some point. So we need to look forward and say that Enphase, superior product in a growing market. I believe they have a bright future, no pun intended, and I'm willing to buy this company if it drops to around $100 a share, just like Datadog. So I'm going to start moving a bit quicker because these next stocks are a bit farther away from my price targets, so I probably won't be buying them anytime soon, but I am still watching them. So the next is Icon, ticker ICLR. I need this one to drop about 15% before I become interested in dollar cost averaging. Icon is quite an interesting company. They are a outsourced clinical research company for drug development. So essentially, if you are a drug developer, you can hire Icon and outsource the development and commercialization for your drug to this company. Icon claims that they have developed a majority of the best-selling drugs over the past few years, so clearly people are using Icon's solutions, and it shows. Icon's revenue and profits have steadily grown, with revenue up about 5% year over year and profits up 27% year over year. So that's incredible. Icon just becoming more and more profitable while their top line revenue continues to grow. And this business does generate a lot of free cash flows. So last year they generated almost $1 billion in free cash flow. Their current market cap is about $24 billion. So 24 times free cash flows is definitely on the lower side of stocks that I analyze. So it's not terribly expensive. But when we look at the share price, we can see that it just doesn't really dip that often. And for me, I already own a company called Thermo Fisher Scientific, which is also a play on the drug discovery industry. So for me to add more exposure to drug discovery, I want to be a bit picky, which is why I'd like to see the stock drop 15%, putting it close to the teens as far as price to free cash flow, which at that point I would consider a bargain, and I would love to start dollar cost averaging into Icon. Another reason why I wouldn't just decide to jump in today is because they don't have the best balance sheet. So Icon does have a lot of debt. They have about $8 billion in debt, and their cash position is not anything to write home about. They are strongly free cash flow positive, so they should be able to pay off this debt. However, it's still an issue. They do say that they did refinance their debt in the most recent year, which is nice to see. However, it still remains a risk for Icon, so I'm willing to be a little bit picky. Next up is GE Vernova, which I would need to see drop 22% before I become interested. This is a recent, I wouldn't call it IPO, a recent spinoff from General Electric. And you can see that investors who bought the first day of trading have been rewarded very nicely. The stock is already up 75% since the spinoff just 6 months ago. So that's why I need to be a little bit picky on GE Vernova. This company, however, does just look so appealing to me. So it's a play on clean energy. It has a very low price to sales of under 2 times. Google Finance isn't showing a PE ratio yet, but if we annualized the net income from the previous quarter, then we would get a PE of about 26, which is not too bad. Revenue growth is not amazing. However, earnings growth for the year is expected to significantly ramp up. So this stock is going to become cheaper and cheaper, and they do generate some amazing free cash flows. So price to free cash flow, again, is incredibly low. I just really like what I see with GE Vernova, but the stock has just become so expensive. Everybody else saw the same opportunity that I did and started piling into the stock, which is unfortunate. However, just because something is a wonderful company, like I said, it does not mean it's a great investment. You can definitely overpay for a wonderful company. I think the bright side here is that GE Vernova set very high expectations for the market, and the revenue guidance, they said it's trending towards the higher end, and they gave this big window for free cash flows for the year. So I think if GE Vernova falls short of either of these metrics, the market will punish the stock. So I'll be looking to potentially start dollar cost averaging if we see a big drop in this stock. Next stock I am watching is Fiserv, ticker FI, and this is a company that you may not have heard of, but you definitely have used. Fiserv partners with banks for things like account processing, digital banking, and more. So essentially they are the technology partner to banks. Think of it sort of like the technology backbone for a bank. Fiserv, again, is just a wonderful company. They are seeing this amazing growth on both the top and bottom line and with their operating margins. They have a really diversified revenue stream, with digital payments being the primary segment, followed by issuing and banking, all of which are seeing steady revenue growth. But when we look at the stock, it's just been on a tear. It's up 45% in the past year. And if we look over the history of the company, we can just see that it's historically been a really strong performer. When we look at price to sales, we can see that they had revenue of $19 billion last year, and they're a $100 billion company. So that's approximately 5 times sales, which is not bad. However, we don't really want to value this as a growth company because they're not growing that much. It's still single digits. And we look at the PE, it's 30 times. So it's certainly not expensive, but it's also not cheap. If I want to buy Fiserv, I want to buy it cheaply because this is the established leader. I don't anticipate a ton of future growth for the company. And even though they've performed incredibly well and have executed well, that doesn't mean that they're a great investment today, because a lot of that great execution, in my opinion, is priced into the stock. Typically, when I create my price targets, I look at things like price to sales and how the stock has traditionally traded, price to earnings, price to free cash flow, and what I believe about the future of the company. I also want these price targets to be somewhat realistic, so I look back over the past 1 to 5 years and make sure that this is a price that the stock has traded at in the recent past. All right, next few I'm going to go through quickly because they are quite far away from my price target. The next one is Broadcom. Broadcom is a data center play. They develop semiconductor chips for data centers, specifically for networking applications of data centers, essentially getting all these computers to talk to each other. But they also develop software. So they are a software and hardware play, which is kind of the ideal business model. You get the recurring steady revenue with software, and you get the quote-unquote moat that comes with your intellectual property for your hardware. So Broadcom, wonderful company, nearly $1 trillion company, and the stock has almost doubled in the past year. So yes, the company is seeing very strong revenue growth, but most of this is from an acquisition of VMware. So most of this is not organic revenue growth. For me, I don't anticipate the AI chip spending to continue to be this strong. I don't think it's going to disappear anytime soon. However, I think we're going to start seeing a peak in AI spending soon as companies have finished building out their data centers and begin to sort of scale back. So with Broadcom, I want to be very picky, and I'm looking for a price of $110 per share. Again, I might be being too picky here, but if it never happens, then it never happens. That's fine. Next up is the Trade Desk, and the Trade Desk is a stock that I used to own, which just continues to go up, up, up. So maybe I shouldn't have sold this one, but I did do quite well in the stock, so I'm not too upset with myself. Trade Desk is an ad tech company. They are a programmatic ad company, and they play on the connected TV thesis. So that's essentially just streaming as opposed to linear TV like cable. So Trade Desk has seen some huge tailwinds lately with the rise of streaming services and with the rise of automation, especially in ad selection. At the end of the day, they provide a platform for ad buyers, and they stand to benefit from the fundamental shift happening in advertising from traditional advertising methods to digital advertising, things like streaming services. And clearly it's paid off for them. They have been growing like a weed. Their revenue has grown 23% year over year in the past year and has been strong double digits every single year as far back as 2015. So this is an incredible growth company, but again, it's at an incredible premium. So the stock currently has a market cap of almost 52 billion with sales last year of 2 billion. So this thing is trading at something like 25 times sales. And as good of a business as it is, I hate to pay more than 20 times sales for anything, really. So trade desk, I would like to see come down quite a bit, 34%, before I begin getting interested in getting back into the stock. The next two stocks need no introduction. Those are NVIDIA and Palantir. Both wonderful, wonderful, amazing companies, but both incredibly expensive. NVIDIA, I would like to see drop 36% to a price of $75, and Palantir, I'd like to see drop 45% to a price of $20 a share. Now, I know that this seems extreme, but I do believe that both these companies are quite expensive right now. And even though they're amazing companies, I think buying them now is just not the best investment. I don't think they're going to perform poorly, but I just don't realistically think that these two stocks are going to outperform the market after they've already run up so significantly. So Palantir, NVIDIA, amazing companies. I used to own both of them at one point. I've since sold, and I would love to get back in if the price is right. So those are the 10 stocks that I'm watching. Let me know down below which of these stocks you find interesting and which you don't. Thank you so much for watching. And if you're new to the channel, please subscribe. I post stock deep dives and stock analysis videos on a pretty regular basis. So if you like that kind of thing, definitely follow me along for the ride. Anyway, thank you so much for watching, and I hope you have an amazing day.